Let's get more on this supply cut by OPEC, officially 2 million barrels a day. And we also got inventory numbers for the U.S. energy market. We're joined by Andrew Lipow of Lipow Oil Associates. Andrew, just kick off if you would, and thanks very much for joining us with OPEC+. You and other veteran observers are pointing out they're not even producing near their quota. They're still, well, in August, I believe it was August, they were about 3.5 million barrels short.
Well, that's right. In fact, in September, it's estimated that OPEC Plus is missing their production quota targets by 3.6 million barrels a day. So this announcement of a 2 million barrel a day cut in their quotas, I think really translates into something more like 900,000 to 1 million barrels a day, because the brunt of the production cuts are going to be borne by Saudi Arabia, the United Arab Emirates, and Kuwait, who are producing right at their quota targets, and to a lesser extent, Iraq and Russia.
Yeah, so so the Saudis and the United Arab Emirates in the near term will be the ones who bring in their production in real terms?
Well, that's exactly right. If we look at this production cut, it amounts to about a 5% reduction in each individual country's production target. So for Saudi Arabia, who's producing at around 11 million barrels a day, this is going to equate to about a 550,000 barrel a day cut.
Walk us through the crude oil inventories here, Andrew. I know you haven't had that long to look at them, but crude oil inventories down marginally in America, down about 1.4 million barrels in the latest week. Are we seeing any kind of tightness in fuel supplies in the U.S.?
Well, we are, and we shouldn't look at the crude oil inventories and commercial stocks alone. We need to account for the draws in the Strategic Petroleum Reserve, which this week were another 6.2 million barrels a day. So the total crude draw combined with the total refined product draw in gasoline and diesel approached 16 million barrels. And this is what's concerning the administration, because they look around the country, they see gasoline inventories in the West Coast at a 10-year low, gasoline inventories in the Midwest at a 30-year low. And as we go into the winter, diesel inventories are at their lowest level since October of 1996. So this is causing great concern about price spikes.
I see President Biden is quoted today as saying, I need to see the detail of this production cut by OPEC+, but I am concerned it's unnecessary. So it must be frustrating for him if it helps to push up gasoline prices in the U.S.
Well, I think what we're seeing is that the administration has been trying to get OPEC Plus to actually increase production, and that strategy is really not working. OPEC Plus is going its own way, trying to increase their revenues. They're also being hit by a stronger dollar and inflation, but it just shows you that they're really quite independent of the United States, and our influence on their actions is waning.
Isn't that interesting? And of course, there have been signs, well, the Saudis and the Russians have moved closer together in that they've teamed up on production increases and reductions. So Moscow and Riyadh moving closer together in some ways.
Well, that is really correct. And what we're seeing is that the United States and the European Union, of course, are paying higher energy prices, not only for crude oil and refined products, but for natural gas and electricity. And I think that these production cuts are going to continue to lead to a recession in Europe that could easily spread to North America and then ultimately to China, as consumer budgets are stretched and they simply can't afford consumer goods.
Where do you see oil going in the next year, Andrew? Do you see it getting above WTI? Do you see it getting above $100 US again?
Well, I certainly see that we can drift right back up to $100 a barrel. We need to get more energy out of the ground. We need higher prices to continue those investments, which are really being hampered by supply chain issues, whether it's frac sand, drilling pipe, getting more crews to the sites, as well as getting truck drivers. And we've seen the Energy Information Administration actually revise downward their 2023 oil production forecast, which is concerning given that demand around the world continues to be quite good.